You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. This week, I'm going to press play on a webinar that I recorded recently for the broader market and a few client bases. I thought we should share that with the broader Perth Property Show listenership. Now, you're going to get the audio version of this. Obviously, if you're looking for the video version as well, you can head over to strategicpropertygroup.com.au/webinar, and it should be pretty easy to find. Before we press play, though, I will make a couple of comments quickly on the WA state budget announcements specifically made to the housing market. Couple of key points here. One, firstly, the $5,000 incentive for Airbnb owners to put their property back on the private rental market. Look, in lieu of a property tax, it's not a bad idea. We'd all rather have an incentive than a tax, wouldn't we? However, again, another policy chipping at the edges at what really is a crisis right now and is taking the airspace of policies that really should be enacted that would have much larger impacts on our market right now. The second, and I guess more pertinent and important announcement has been the raising of the first home buyers rate of stamp duty from $430,000 to $450,000. Some would say don't bite the hand that feeds you. I would suggest that this number is quite a disappointing number. We've been calling for the indexing of that first home buyer's rate of stamp duty for quite a while now. That would send the threshold from $430,000 up to about $650,000 right now. And we'd never have to talk about this problem again. When median house price goes up, the threshold goes up. When it goes down, the threshold goes down instead. Unfortunately, Treasurer Saffioti has retained the opportunity to allow the state government to continue to profit off of young Western Australians with the bracket creep situation of the median house price increasing far above where she is prepared to update the rate of stamp duty threshold. In that time, the state government will continue. In this space between $450,000 and $650,000, the state government will continue to reap tens of millions of dollars off of young first home buyers who would have otherwise been able to move out of the rental market far quicker and not pay $30,000 in stamp duty. They're still going to have to pay for a median house price purchase. So a very disappointing outcome coming out of the budget. I hope they have some time to reflect on this before the election, as the commentary from punters all over social media is already pretty damning. Anyway, let's press play on the webinar. I hope you guys enjoy it, find it informative. If you have any further questions, feel free to drop a line at inquiries@strategicpropertygroup.com.au. Happy hunting. G'day guys, Trent Fleskens here, Managing Director of Strategic Property Group and host of the Perth Property Show. I'm running a quick webinar today. It'll probably be about 30 to 45 minutes, detailing where I see the property market in Western Australia sitting right now. I'm going to run through a number of slides, some stats, a few anecdotes along the way, all the experience that we've garnered here at Strategic Property Group through our investment, involvement and development in the property industry in Western Australia, and the conversations that I have on a weekly basis on the Perth Property Show with the best minds in property in Western Australia. So we'll crack on with the webinar, and we'll start with the same slide and a couple of slides that I start every single presentation. Gets everyone on the same page. We're going to start just like we always do, understanding that one source of truth, really, and that is what we're all here for to really understand is what's going on with the price of property, whether it's residential, commercial, doesn't matter what it is. It can be any asset, to be honest, not even just property. And how does that move? And often I think we can get caught up in headlines and feelings, and buzz around town to make our decision about how price growth is going to happen, where it's going to go up or down in the future in our market. And that often happens simply because we have a lack of a real grasp of understanding of how it actually happens. And this is how it happens. If you've ever done economics in high school, it's pretty basic. Price growth only happens when demand growth is greater than supply growth. And we're going to flesh that out a little bit right now. So what do we mean by demand growth or supply growth? So demand growth, top line, is a change in buying power, the ability of the market to pay more with more, essentially. We can track that statistic, and we'll talk about that in a second. The supply side is stock on market. We can track that. That is essentially a change in the stock on available for people to demand, right? So that is the supply growth that can grow up, it can grow down in the same way that demand can as well. And there's one other factor, really, this key factor that also affects the propensity, really, for the effect on price growth that demand has against supply, and that is that credit servicing factor. How much you can leverage via the banks. Now, that obviously gets impacted by really the RBA with their cash rate. That filters through to banks with their interest rate, and then turns into I guess it's most would call it the assessment rate. Now that's the interest rate the banks actually assess you at. So even though the interest rate for you might be 6% right now, they're probably assessing you at more like 8.5% or 9% right now. And that's why you'd wonder, oh, I've done my numbers here. I can afford a loan. Why won't they give me a loan? Well, because they're assessing you at a buffer rate that allows for further increases in the interest rate over and above where it is right now to make sure that you're being stress tested. So as that goes up and down, even if you held demand versus supply steady, you will see increase and decrease in prices simply based on a change in the assessment rate coming from a change in interest rates coming from a change in the cash rate. Now, we saw that back in after 2017, where the Haynes Review saw APRA drop their floor on their assessment rate from 7.5%. And as interest rates started to drop, that really turned out for assessment rates getting down to numbers like 5.5%. Now, what that did was artificially increase the serviceability or the wealth factor of people who had not changed their income whatsoever, but with the same income, they could now lend more and therefore pay more at the negotiating table when looking to buy a property. We saw that especially in house and land suburbs like Ellenbrook and Baldivis when they started to move in price a little bit. It certainly wasn't because there was more demand versus supply at the time. They were still well oversupplied markets, but because the house and land space or the first home buyer space could afford more with the same income, they could pay a bit more, and sellers were making them do that in some cases. So then let's flesh out demand growth again, just to provide a real context around how we actually track this, because we can talk about it theoretically, but the cool thing is we can actually track this in real life in Western Australia. And the great thing about that is we can get that data from REWA, which is a fantastic organization that provides all this data on a weekly basis. So demand is tracked through the number of transactions we see every week. And REWA published this, as I said. So every week we see new transaction numbers come through of how many transactions we have last week. We don't have a transaction without demand, because there will always be a certain amount of supply. So when demand is meeting supply, we have a transaction, and that's how we can track demand. So in that case, for example, it's interesting to note that every week at the moment we're transacting about 1,000 properties. Sometimes it's 950, sometimes it's 1,050 a week, and we've done that for the last 4 years, essentially since COVID. Pre-COVID, we got into our darkest days, and we had about 550 transactions happening on a weekly basis. So we can see demand growth has increased by 80 to 90%, which is interesting if you think it from a mathematical equation we're looking at here. The denominator is increased substantially. And what we're looking at is context. And for context, we talk about 1,000 at the moment. So 1,000 properties being taken off the market every week. It was 550 in the darkest days in 2019, around March 2019. And for context, in the mining boom, where we had essentially a fabled time in property in Western Australia, where we look back and think it was only price growth, the amount of demand happening every week there, the amount of transactions happening every week there was about 800 transactions a week. So we've consistently, and this isn't blips and blops, we've consistently, nearly every week, been sitting about 20% above the highs of the mining boom in terms of our demand factor. Okay, so we've seen demand. Let's look at supply now, because if supply has grown equal to the growth we've seen and talked about just then in demand, well, then we wouldn't expect price growth. However, supply has actually dropped massively. What we remember is that back in the darkest days, in about 5 years ago, again in 2019, March 2019, the amount of properties on the market was about 17,000 properties. We're now sitting at about 3,500, and we've been sitting below 5,000 since Christmas. The Christmas before that was 8,000. Christmas before that was about 10,000. So every year the supply number has been dropping. and we're now sitting at less than a quarter, or around a fifth of the amount of properties on the market compared to 5 years ago. So when you look at that, the demand side is up by about 80%. Supply side is down about 70%. It really starts to paint the picture for why in the last 12 months we've seen price growth of 20% and continued price growth since COVID, really. And COVID isn't the reason that prices have been growing. COVID is just, I guess, a watershed moment where the influences of demand and supply in Western Australia started to change. Now, we'll wrap this up in this slide and recognize that practically, where does demand growth actually come from? We can track it. We've just seen how we track it, but where does it come from? Well, it comes from more people, net migration growth, with more money to pay, wage growth. And we've certainly seen that in the last few years. We have a massive undersupply of many trades, many specialities in Western Australia, not just in the construction and real estate industry. And because of that, we have more people allowed in the country, and they are getting paid. We are all getting paid more in general because of the dynamics in the labour market. And therefore, more people, more money means more demand can happen. And there is that real analog we see between price growth and population growth. And then supply side, well, where do we see that? Well, supply side is essentially, we can track that with building approval growth and mortgage stress, properties that are coming unnaturally onto the market. So this is where we're getting new supply otherwise coming into our market to try and match the demand. We've spoken about the change in assessment rates. I'll leave that there. You can see that and track that through a mortgage broker that you use. You can certainly use Strategic Mortgages Perth if you want to, but otherwise any other mortgage broker. And they will help you track where the assessment rates are at any point in time. So let's move forward and quickly look at some of those statistics. In the last 3 months, this is where we've really started to notice some step-ups in volumes. Really in the last 4 years, but the volume side is very much sustaining itself just like it has over the last few years. And this is what I was explaining before. That dashed line there is about where the mining boom was about 12, 13 years ago as an average. You can see it tapering off from 2014 there. You can then see it drop into the darkest days, and you can see it starting to peak up as after COVID hits. And since then, we have sustained at record level demand and transactions ever since. We've never had these numbers before. You can't go back any time in the past and see the numbers we're transacting every week. And what we're seeing is we're actually taking off of the market about 30% of the properties on the market every week. So if you think we're buying 1,000 properties a week and we're only bringing to market 900 properties a week, well, you can see how over time the supply in the market starts to erode, by thousands over the years. This is very stark here what we're looking at. So this is demand side. You can see that in the top left-hand corner of every slide. It says demand there. You can track that going forward. Again, we're in a demand slide here. We've now got an input, a population growth, right? And this is probably the strongest analog, as I said before. If you had no other interest in the other stats, all you really have to do is watch immigration numbers. Price growth tracks very, very strongly with immigration numbers because immigration can happen quite quickly. But to be able to supply a new piece of dwelling, a new unit of dwelling to the market for that demand being population growth, it takes a couple of years to provide that. So every time that there is a lag between demand occurring and supply being required, supply being met, I should say, that's where you see generally price growth. So as you can see here, if you have a look at natural increase, well, that's just new babies born. They don't need new houses. They don't buy houses. But more importantly, overseas migration has ticked up to a number that is last year about 90,000 people, equal to the total amount of people that have come in the state since for the last 5 years. So we've had more than 5 years worth of migration in the space of a year, and that's why obviously supply is struggling to pick up. Where's it coming from? Well, obviously a lot of overseas migration and some interstate migration. And the makeup of that is quite interesting, actually. We'll talk to that in the supply side soon. Now we have a look at finance commitments. Where is the money going when we think about price growth, demand in the market? Is it going to investors, owner-occupiers, first home buyers? Well, it's interesting to see how that dynamic has changed over time. So initially we saw it was the owner-occupier and the first home buyer really moving into the market. Those are people who are moving into purchase property out of necessity. These are people who are upgrading with cheaper interest rates around COVID. They're making that socioeconomic jump that they otherwise never would have been able to, and probably never will be able to going forward, when interest rates are at about 2%, now at 6%. So you can see the conundrum a lot of people in that position may have right now if their income hasn't grown and their mortgages have stayed the same. And then from there, obviously, first home buyers, you saw the building boost, a big part of that straight away. First home buyers getting in the market there. Some of them are just starting to move into their home now, 3 or 4 years later. And then more slower uptake, and certainly an uptake from the East Coast, the investor market coming on after that, recognizing the uptick in demand, recognizing the downtick in supply, and therefore recognizing the opportunity in price growth. And we've seen that across certain suburbs in Western Australia, where we're up in a 5-year space 70, 80% in some suburbs, certainly in the lower socioeconomic and lower socio-demographic spaces in Western Australia. And we can see here the investor space is really starting to creep up. We noticed that when it gets to about 50% historically of investor money being poured into the demand side, that's when markets really start to demonstrate they're getting too opportunistic and greedy. There's not as much of a foundation there where the dynamics can start to topple. We're certainly still not there yet. We're in the mid 30s, as we can see. We've come from a really low base, and this is why our rental market is so knackered. We simply do not have the investment properties we used to. We have thousands, in fact, less rental properties than we did a few years ago. And the office and the Department of Commerce can track that with the bonds online system. We just have far less properties on the rental market at the same time that we have a far higher demand for it with immigration coming in. As you can see, first home buyer space stays fairly strong at the moment. It's certainly the investor space that is starting to enter that market, pushing prices in the right direction for a lot of people. Now, this is another indicator on the demand side, and that's median days on market, how long it takes for a property to be put on under offer since it has been listed. Now, if you think about a natural time frame, it probably takes a week really to go from being listed to the first home open to getting it negotiated and then putting it under contract. That's the quickest you'd really want your sales agent operating in the first place, even if you had a hot property, because you want to stem out as many buyers as possible to get the best price. So we think about 7 days being like a natural zero in the property market. Well, we've gone from about 3 months when you look at our numbers here. We've gone from about 3 months to less than 2 weeks. And this is an indicator of how strong our market is. And this is a median time, right? So there are obviously half the amount of properties in Perth right now going for less than 11 days, going in less than 11 days, and half going sometime above that. So it's very interesting to note the amount of properties. So 500 properties per week are being sold in less than 11 days. The other 500 taking some time after that. This market essentially is an inverse to where this graph, I should say, is an inverse to the price growth. If you look at it, if you flip this over, it's pretty interesting to note that as well. Now, let's enter a little bit of the supply conversation. And this is actually why our prices are growing so quickly. As I said, we've grown about 20% in the last 12 months, 5% in the first quarter of this year. And most people have now started to provide a bit of consensus that they expect prices to be 20% for this calendar year. So sustaining the growth we've seen over the last 12 months. It's coming because we do not have the supply coming on, and we do not have the capacity to supply the amount of properties coming on. If you think about the national housing targets that have been set by the Albanese government, they sit around 26,000 properties in Western Australia. That really is actually quite conservative. Some would say they're aspirational, but they're conservative compared to what we need in Western Australia. We need about 30,000 to 35,000 properties to be built at the moment. And we've needed that for a couple of years. We're building 15,000 to 16,000 properties over the last few years per year. And that is, as most people would know, our trade base at full capacity, not having a holiday and breaking down physically, emotionally. We are at capacity, which is why we've seen construction costs rise by about 60% since pre-COVID, which is obviously having a huge impact on the equivalent housing price for the established market. The replacement value is what we would call it. So As you can see here, that 25,000 line there is where the target is. And the worrying thing is that, as you can see, other than the blip we had with the housing boost that came in with the grants, we have been heading generally in the wrong direction for a very long time. And that very long time stems from the last mining boom, actually. If you take the blip out, we're still trending down away from where we need to be. And that is what the real issue, the big issue is in Western Australia right now. It's actually not the amount of demand we have. Yes, demand is record high, but it's slightly higher per capita and sustainably, I should say, than it was in the mining boom. What our big issue is the amount of supply we don't have, being just less than 4,000 properties on the market for a state of 2.5 million people. But more importantly, the direction that the new supply coming on is taking with regards to our labour market. And that is a problem that we in the industry have analysed quite seriously in quite depth and don't see an answer to for quite a few years to come, which forebodes really where price growth must go in the meantime. So this is a deeper look into dwellings under construction, and I guess the part that's really concerning here is the downtrend we're starting to see again. As you can see, the construction numbers tipping up with the building boost. Since then, it's ticking down, not up, and at no point in time has it actually really ever gotten to an amount that we need it to be going forward either. So that's the issue. When you think about the amount of properties that are being built in the segments of the types of dwellings, it's either housing or apartments. And what we know is we had less than 1,000 apartments built last year in the whole state for the whole year. Not because there weren't developers who wanted to develop, but because the construction cost and the construction risk to achieve that was far too high to meet the demand in the market and the pricing in the market. And so nothing happened last year. Nothing's really going to happen this year other than finishing off a few of the developments that were committed to at the early stages past COVID. And the pipeline is even drier. And that's what's quite concerning, because in the house and land space, there are capacity issues there, as we spoke about. We don't have the available titleable land in Western Australia to do more than the amount that we've been doing over the last few years at about 15,000 dwellings or pieces titled land, pieces of land to be able to build on. And therefore you can't build on land that hasn't been titled. And there just is no market at all. The market has failed in the apartment market. So there's no ability to really ratchet that up at the moment. And that's where the concern is. So here are some numbers here in terms of breaking down the cost structures. So it's wages have gone up on average a little bit. You would see in some of the trades it's substantially more. For example, in the bricklaying trade, roof carpentry trade, roof plumbing trades. It's the material cost and the general other broader costs that are the issue. And this number comes from a couple of year time frame, but over 5 years, it's now sitting at about 60%. So we are really starting to feel it overall. And this is where I mentioned here that numbers really starting to tick up from a few years before 2022. That index is coming in there. Costs will not drop. So a lot of people think, oh, don't worry, things will settle down. The price to build a new home will start to come back a little bit and it'll make it easier for us to get on with it. That will not be a reality. And because the only time that prices drop, as we've looked at in the first slide for anything, is when the supply of that good or service grows faster than the demand. And we know the demand is insatiable right now. We're tracking, catching up on years of that 10,000 house deficit between 25 and 15,000 that we've been at over the last few years. So we're playing catch up. We have continued demand, continued population growth, and we have not been able to respond in the supply space. So when we think about population growth, for example, we said 90,000 people came in last year. That means about 50,000 new homes were required. 50. Well, we only built about 15 or 16,000. So we continue to put the market into deficit, push people, more people per home. Making people live now, as you would see on the news, in a multi-person, multi-tenanted house, renting per room, for example. And that's what puts all that pressure, obviously, on the rental market and therefore the supply market. And what's happening is it's starting to really put all that pressure on the social housing and homelessness space. So I don't envy John Kerry, the Minister for Planning and Housing in Western Australia. He's picked up a deplorable portfolio that he's inherited, essentially. The previous ministers totally neglecting their responsibilities for social housing, in fact, having net negative numbers over some years pre-COVID in terms of their building of social housing, which has led us to be in a position of about a 20,000 house deficit for the social housing space that has really only reared its head since the rental market has become so tight. Because what was happening was, even though we still had those people who always would have needed social housing, that was being, I guess, covered, quasi covered by the private rental market, which sort of was operating in a quasi government capacity when there was capacity in the rental market. And as the rental market has gone from having 11,000 properties on the market with a median rent of $350 a week, and a rental vacancy rate of 7.5%, down to about 2,000 properties on the market, median rent of about $660 a week, and a vacancy rate of 0.3%, all those most vulnerable and least attractive tenants, I guess we would call them, have now been pushed into social housing if they're lucky, and homelessness if they're not. And that has really started to show the gap we have in the government space on the social housing builds that have not been happening over the years. And that's why, for example, Minister Kerry has had to announce another $560 million to be spent going forward on more social housing. He'll have to keep doing that. And $100 million on homelessness. Imagine if that money was spent on social housing 60 years ago at 60% less of the price. I'll let that sink in. What we could have done with that money back in 2017, 2018, those times where build prices were far less. And imagine the trades we would have continued to generate and keep. And imagine the amount of trades we'd have now that would not be so critical and not be such a constraint on our supply. And that's what really has boiled down to the issue we're in right now, is we do not have the people to build the houses we need, even if we brought population growth back to its long-range average. And therefore, when the supply growth cannot even get close to meeting demand growth, we recognize that prices must continue to grow. So this is nationally, some targets here, and you can see it's quite deplorable again. We never have even, we've met it once. Looking forward, we don't expect to meet this for another 4 years nationally. So in that time, we will continue to be in deficit, continue on a yearly basis, and it won't be until FY28 that the Master Builders Association actually thinks we'll do a year where we meet the supply needs nationally, let alone the more chronic supply needs in Western Australia. And that tells the story again for where prices will continue to go. Now, this is the average time to complete, and this is causing more issues as well, because as we said before, if you could have a piece of supply to immediately meet the piece of demand that comes in every time someone enters this state or someone wants to buy a house after being born, then there wouldn't really be price growth, because supply would always meet demand. The issue is here supply is continually pushing out, and we can see that most critically. To be honest, they're both critical, but we're seeing it happen on both sides of the equation. Apartments and houses have had huge blowouts, where essentially that time is more people clogging up the rental market and not allowing new people to come into this state who will generally rent first. And that's what's causing the issues in our primary market, which is the rental market. People rent first, generally, whether they live here or have just moved here, and not being able to do that is becoming a big issue. So those are the stats. They're pretty stark there in terms of time frames, which also obviously adds to interest costs for homeowners, for developers, and therefore escalates the cost of construction again. Now, we'd like to solve this problem with urban infill. We've got a white paper from the state government over a decade ago suggesting that urban infill targets need to be met, and that target is 47%. The sad thing is that not only have we never met that target, which is obviously being taken by urban expansion, house and land packages on the fringes, we are actually moving in the wrong direction. We're far behind where we need to be. And so the amount of properties we're building right now, the problem is being solved by house and land. Why? Because it is the path of least resistance for the market and for the government. It has far less planning issues. It has far less community issues and far less risk, because you can develop smaller patches at a time, sell one block at a time. You don't have to take on 5 to 10 year projects to hope to make similar, if not less, profit as a developer than a large-scale land development, which, if you think about the amount of money some of the large-scale land developers have, wouldn't be surprising as to how that continues to happen. So culturally, we need to get better at being a yes in my backyard, not a no in my backyard, recognizing that if we do care about trees, we do care about the taxpayer dollar, and we do care about keeping cost of services and making our dollar down and making our dollar go further in Western Australia, the answer is infill. We had a chat with the biggest land apartment developer in Perth, Finbar, a week ago on the podcast, and the Civic Heart development in South Perth will provide 309 apartments on 8,000 square meters, 0.8 hectares. Now, to do that in a land development would take about 20 hectares. So a 20th or less than a 20th of the space of land required to house the same amount of people, 309 dwellings. Now, when you think about protecting trees, I know which outcome is the one that would do that, and which one also helps to build more vibrant activity centres and share the existing cost of services that we have, bringing down the cost of infrastructure rates and all those sort of things in Western Australia. Infill is the way. I'd rather have one 20-story apartment in the shopping centre than 1,000 triplexes around within a 5K radius. We can do that. So let's move forward to the next slide. Average income needed. And this just reminds everyone in Western Australia who may have some preconceived idea that property in Western Australia is inherently less valuable than Western Australia than the rest of the state, or that we inherently have lesser income earning potential, or that our prices in Western Australia are getting to a point where they're unsustainable. The average income needed to afford a house in Sydney is now nearly $300,000. And that's why things are pretty tough in Sydney. That's why our cost of living is twice as tough as it is in Western Australia. Imagine that. In Perth, it's 140,000. And what that indicates is that even though we make slightly more income than people in New South Wales, we have a far better lifestyle in terms of our living standards, in terms of our cost of living, but also far more space for prices to grow if they have to, if we can't solve this problem. There is no cap right now because we can see the same culture, the same finance system, the same market dynamics in Sydney where prices are nearly double. So if we look at Sydney as simply being the future of where our prices will go if we can't fix this problem, given the same dynamics, then there is no argument to suggest that for the reason of prices being too expensive in Perth, prices would drop or would cap. In fact, we have the capacity for prices to be higher, and we've seen that back in 2008, I believe. Prices in Perth for a short time were actually higher than prices in Sydney, and that demonstrates just how much we've lagged in the last 15 years and just how far Sydney's house prices have gone in that same time frame. There's no economic argument to suggest why we can't be in the same or won't be in the same position again, although most don't expect it. If we continue to not be able to meet the supply requirements in Western Australia to meet the demand from the existing population, let alone the population growth we have, then prices can and could grow in the same vein as we've seen Sydney over the last 15 years. So let's talk about those numbers quickly. How many properties need to be built every month in Western Australia going forward? Well, about 3,000. How many are we approving? About half of that. And that isn't getting any better. It's actually getting worse. So that starts to lead into that conversation again about prices. Let's look at the rental space again on the outcome side. We're in the outcome section of this webinar. Rent rises are continuing to happen. As you can see, as the amount of rental properties available on the market has dropped by 80% in the last 5 years, so has the median rent increased by 80% in the last 5 years. So there's a very strong correlation between demand and supply and price growth in our primary market being the rental market. And there is no reason why Perth's rental prices won't, unfortunately for many, continue to grow to reflect the continual chronic position we are in. At no point in recorded history has Western Australia had a vacancy rate this low, and at no point in recorded history has Australia had a dwellings on the market per capita this low. We are in wartime situations here. In the same vein that post-war we had a massive housing crisis in Western Australia, similar to what we're in at the moment, but certainly not to the same extent. The state government ended up building about a quarter of the properties over the next 10 years that were being built simply for social housing, to house anyone that needed a home. That was what happened when it got critical. Now, that's not to suggest that that's going to happen in West Australia again, but it certainly suggests the gap between what's happening right now, what's being done right now by the state government, with policies that chip around the edges on infrastructure funds and incentivizing Airbnb people to rent their property out to the private market, and what needs to be done structurally to help supply. And that's at a federal level, to be honest. When we think about the amount of people that came into our country last year, we know that number, we've spoken about it. Only 2,500 of those were skilled migrants in the construction space. We need about 30,000 people 30,000 tradesmen to be able to start supplying the properties we need going forward. And that is the crux of the issue right now, is we don't have the trades available because they've all gone to the mines or didn't have because they left their jobs or didn't have a job back in 2017, 18, 19. Would have helped if we had social housing programs to keep them in business. And we just do not have the amount of people being let into the country with the right skills. The issue is not the amount of people coming in via population growth. The issue is the skills those people do or don't have. And 2,500 people with the skills to help build homes is by far and away nowhere near enough people to solve the problem we're in right now. So until the Albanese government stops protecting local Australian unions and industry, increasing the cost of supply and housing in Western Australia, and starts actually letting the people in we need with the skills to build homes from other countries, we will continue to be undersupplied and have a cap on the supply of the ability to meet demand in Western Australia. So here's the price growth I was talking about, where the dark orange line there. We will continue to lead the state for quite a while. Why? Because we have nation-leading population growth. We have essentially still the most affordable housing in Western Australia. It's coming close there with Hobart and Adelaide, which generally prices for us should be higher than them anyway. And we don't have any changes to those dynamics. So because of that, we will continue to be Western Australia leading the way, which is quite nice for the first time after a decade of being in the doldrums. However, that puts pressure on the most vulnerable in Western Australia, which is why we need to solve this problem, which is why this isn't a good thing long term. Let's look at those annual price changes over the last 30 years quickly to give us some context and round this conversation out. This is why we're able to see price growth to the extent we're seeing it right now. We really haven't seen material growth for about 20 years, if you look back in that context. So this is our time. It's interesting to note back in 2006 that number was 40% in a year. Hard to remember, but that was only 20 years ago when most of us were alive. Could that happen again? If we can't solve this supply capacity problem, then there's a conversation about that as well. Let's quickly break down the regions. You can see in Western Australia where that price growth has come. It's no surprise to people who listen to this podcast that it's Armidale, Gosnells, Rockingham, Kwinana. And that really has been driven by a massive investment attraction from East Coast investors. These are people who are who have been conditioned in the East Coast, in New South Wales and Melbourne, that if they invest in property at the right time, they will be rewarded handsomely to an extent greater than their incomes will allow them. And if they don't, they will miss out, fall behind, and see their friends who did start to live a life financially that they aren't. So they've come in with a desperation of FOMO to move into Western Australia, a market that they can afford compared to Sydney or Melbourne. And we've been sitting on our hands, one, because we're just getting equity back in our properties that we lost over the last 10 years, and we can't buy without equity. And two, because we've been burnt. We've spent many years being conditioned to think that our properties aren't worth the same as East Coast people, that our properties can't grow in value for some reason, even though they're constructed in a more solid and expensive way with double brick. So we're behind the eight ball here. People who have come from the East Coast and invested into some of these suburbs, Armidale, Gosnells, Rockingham, Kwinana, these local governments, I should say, have made if they got in early, 70, 80% in that time in these suburbs. And only in the last year we've seen these suburbs within the LGAs on this graph here making the better part of 25 to 30%. So the reason for that, well, because that's where the best rental yields are. It's where the most people, investors, first home buyers can afford to buy as well. And that scales down, essentially. The more expensive property gets in Western Australia, the less affordable, the less buyers, the less supply needs to come on as well. It's not to say it's not to say it's oversupplied. There's not really any oversupplied property in market in Perth right now. But the extent of growth is availed by the extent of affordability in that $400,000 to $800,000 space in Western Australia right now. That will eventually ripple back up as interest rates drop. Let's say it's next year now, and the price of property in Armidale, for example, starts to get really close to the price of property in Canning Vale, or the price of property in Ellenbrook starts to get close to the price in Morley. And then you start to have the market ask questions as to why, and they'll start to pay those prices for better suburbs, given it's compressing up so high from the bottom right now. Cumulative changes, as we've seen there, that's the housing market and the unit market. On average, since COVID, 50% for houses. And quarterly, 5% just in the last quarter, which is how we're seeing 20% come through. We've spoken about that. And this is just a bit of a graph to demonstrate visually where that growth is going. Grey being the least growth, and orange being the most growth. As you can see, the most expensive parts in Perth, not from a lack of wanting, but a lack of capacity given interest rates right now, are the areas with the least price growth, and the areas that are the cheapest, the furthest out, are the ones with the most price growth, as we just spoke to. Quickly, we'll look at the regions, and it's Bunbury that is doing the best right now in Western Australia, outside of Perth. And the reason for that is simply it's a mini Perth these days. It's got everything you'd want, all the amenity. There's a multifaceted industry, very few risk factors there compared to your Karathas, Port Hedlands, and these areas, which is where you're seeing price growth starting to come back a little bit, actually, as you can see on this board. And it is the more diversified southwest markets that are seeing the most growth. And that will continue to happen, as well as people will make tree changes based on affordability and job opportunities. Let's finalise the extraordinary gains we've seen there. Perth's median house price currently sitting about half of Sydney's. I would not be surprised if we are second in the country in the next couple of years, for the reasons we've spoke about in the last 40 minutes. Finally, again, just a reminder, if you have any questions, feel free to give me an email at inquiries@strategicpropertygroup.com.au. Please listen to the podcast every Monday at 7 a.m. It comes out on Apple Podcast and Spotify. And please, if you are looking to buy or sell a property, do get in touch with us for an instant quote on strategicsettlements.com.au. Thanks for listening, everyone. Appreciate your time. Appreciate everyone asking for the webinar to happen, and we'll be sending this out to our entire database and the database of those businesses that work with us. So have a good day, happy hunting, and hold on to those properties for a while. Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!